guys, so let's start discussing about Index 2. Guys, Index 2, like your AS2, talks about inventory. Who doesn't know about inventory? Because right from our basic days, where we were talking about accounting concepts, accounting conventions, etc., we did speak about even inventories as well. So it is such a fundamental standard, and one has to definitely have enough understanding or enough clarity on inventories. So whenever I talk about this word inventory, I always start with the logic of what do you mean by an inventory? And sometimes I am struck with a small concept of a differentiation between what is an inventory, and how is it different from stock? Can you differentiate between inventory and stock? Sometimes in the balance sheet I find stock, sometimes in the balance sheet I find it as inventory. Now, stock does not have a standard because Index 2 is talking about inventory, it is not talking about stock. Then what is stock and why are we using these words interchangeably? Do both of them mean the same? Exactly, that is what my understanding. Let's see what inventory and stock stands for. When I talk about inventory, inventory is defined under AS2. Defined under Index 2. And the definition goes something like this. Inventory is an asset which is number one, held for sale. Don't stop there. Held for sale in ordinary course of business. Number two, in the process of production, not yet produced, but still in the process of production. Number three, held as supplies to be consumed in production process. Now, someone told me that inventory is raw material, finished goods, and WIP. But here I am talking about a different wordings altogether. Held for sale in ordinary course of business. I said that word ordinary course of business is very, very important because an asset which is held for sale is also covered under Ind AS 105. But that is what I said, non-current asset. These are assets which are held for the purpose of trade. That means my operating activity itself is trading in that particular asset. For example, let's say I told you furniture which is held for sale is in days 2. Yes or no? Answer may be yes, maybe no. Because if I am a person who is dealing with furniture like IKEA, then for such organization like IKEA, inventory, the furniture becomes an inventory. But let's say I am an education institute which is using benches for providing education to my students, then furniture is not my inventory. Even if the inventory, even if the asset is worn out and is held for sale, I will classify it as Ind AS 105 because sale of my furniture is not my ordinary activity of business. Correct? So that is why held for sale in ordinary course of business. This is nothing but my finished good. Held in the process of production is my WIP. Similarly, held as supplies to be consumed in production process is raw material and also my consumables. Yes guys, so we were discussing about the difference between an inventory and a stock, and I said inventory is defined under Ind AS 2 as an asset which is held for sale in ordinary course of business or in the process of production, or held as supplies to be consumed in the production process. That means, in the simpler terms, it includes finished goods, WIP, and raw materials as well as consumables. Then, what is stock? No one has defined stock, there's no standard which defines stock. So, that means basically, when I talk about stock, I would take a more definition from a dictionary where it basically is a collection of items. So I can say that there is a stock of finished good. I can say there's a stock of raw material. I can say there is a stock of old newspapers. So a stock need not necessarily mean an inventory. An inventory is a rigid definition while stock is a very inclusive definition. So there can be multiple other items which can be also forming part of your stock rather than being in a form of inventory. Then why are these words used interchangeably? The interchangeable term here can be inventory, can also be called as stock in trade. Your trading stocks are basically nothing but your finished goods, raw material, and work in progress. So, such similar items can be considered as an inventory, and stock in trade can be interchangeably used for the word of inventory. So, otherwise, a simple word stock means a lot more than inventory. So, I can put it like this: if this is my stock, then a part of this is basically my inventory. So, invent stock has a much larger definition, or a much more inclusive word is basically stock, but inventory is a rigid definition only confined to these three things. Now, let's get ready to understand what the standard talks about, because the standard is very important to understand as to what is included in the value and what is excluded in the value, and what are the standards which are excluded from the scope of the standard. So first, let's have a look at what is the exclusion from the scope of the standard. Exclusions from scope of standard. The standard excludes a few items because predominantly they are covered by some other standard as well. First one is financial instruments. We have set of specific standards which discuss about financial instruments in depth. So I don't need Ind AS 2 to talk about financial instruments. Financial instruments are covered under AS 32, 107 and 109. Specific standards are discussing about exclusions from scope of financial instruments. So therefore, Ind AS 2 need not talk about financial instruments at all. The second exclusion from scope is biological assets, even if they are held as inventory, because biological assets have a complete different measurement principle than Ind AS 2. They are specifically dealt as per Ind AS 41. So since they have a separate way of identifying process, so I will not be including them. Work in progress in construction contracts this construction contract WIP you will be talking about as per Ind AS 115. Earlier it was Ind AS 11, but after Ind AS 115 was released, Ind AS 115 has replaced 11 and 18 two standards. So Ind AS 11 was earlier discussing about WIP and construction contracts. Now it will be declared as per Ind AS 115. These are the three particular exclusions from the scope of the standard when we discuss about India's 2. Now, let's talk about the measurement principle then. What is your measurement principle for inventory? I think everyone is aware of this measurement principle because we have been learning it right from our basic days, where we discuss about inventory should be measured at lower of number one, cost, number two, net realizable value, which we generally call as NRV. This everyone knows. I am not trying to put across something very new. So first, let us break it down into parts and let's understand what is a cost and what is an R. Then we will try to get further into the standard on what is the standard even talking about regarding the principles of measurement. I'll discuss about the first part, cost of inventory. First thing that in cost of inventory, we have to discuss about what are the inclusions in cost and what are the exclusions in cost. The first one I'll put up is inclusions in cost. And then subsequently, I'll also talk about exclusions in cost. Exclusions from cost. There are 3 inclusions and 5 exclusions from cost of inventory. What are the 3 inclusions and 5 exclusions from cost of inventory? First inclusion in cost of inventory is cost of purchase. First one. Second one, cost of conversion. Third one, cost necessary to bring the asset to its current location and condition. Current location and condition. These are the 3 inclusions in the cost of inventory. Then what is your exclusion from cost of inventory? My exclusion from cost of inventory basically includes, I told you there are 5 items. First one, administrative cost. Administrative cost. Second one, selling and distribution cost. Third one, abnormal loss. There is a difference between normal and abnormal loss and their even measurement scheme also. So we'll have to discuss about these 2 aspects of normal loss and abnormal loss. Number 4 is storage cost. Warehousing or storage cost is excluded from cost of inventory. And finally, last one, interest and finance charges. Guys, just to bring about this logic of exclusion from cost of inventory as interest and finance charges, I have discussed in days 23 that in a few circumstances, I'll have to include this interest and finance charges as a cost of inventory. In a few situations, we will have interest and finance charges included as a cost of inventory. One is that situation where the inventory satisfies the definition of a qualifying asset. In such situation, even though Ind AS 2 has excluded the interest and finance charges, I would still comply with Ind AS 23 to add the finance charges to the cost of qualifying asset. That was the reference to the paragraph in Ind AS 23, which had a reference to be made back to Ind AS 2. Now that you have understood just the inclusions and exclusions in cost in a bare sense, there are a few more in-depth understandings which are necessary. Let us try to do it. First of all, what is this cost of purchase? This is the first point under inclusions of cost. Cost of purchase. What does cost of purchase actually include? Cost of purchase includes, number one, the purchase price of the asset. However, the purchase price of the asset should be reduced by less trade discounts, if any. Sometimes the discounts will be allowed on list price of the asset. Such discounts on list price or the trade discounts should be reduced from the cost of the asset. I will add all non-refundable taxes. After this inclusion, the fourth inclusion is a blanket inclusion. All costs incurred until the inventory reaches enterprise premises. What are the costs that would be incurred for the inventory to reach the enterprise premises? For the inventory to reach my premises, I would generally incur first one, loading cost. First, I have to load the inventory into a particular vehicle. The vehicle has to be hired for where I incur transportation charges. Such transportation charges shall be inclusive of transit insurance. Includes transit insurance. Now the vehicle has been arranged, the goods have been loaded. Now what do? Then the vehicle starts moving. During the transit, I incur another cost called as toll charges. You can also call this toll charges in few situations will be called as octroi. Will mean the same, but it is only a license or it is only a permission which is granted for you to use that particular road. And also include weighment charges. What is this weighment charges? I'll tell you. Normally, whenever you look at any industrial area, you will see a particular stores called as weigh bridge. It is called as weigh bridge, or in Hindi they normally call it as dharam kanta. So dharam kanta means basically, kanta is basically a weighing bridge. Dharam kanta because they are saying that their weighing bridge is giving you accurate number. Okay, maybe a marketing right in the name itself. Okay, So basically, when we talk about this weighment charges, why is it very necessary? I'll tell you. Let's say I go to a supplier and the supplier said, sir, this is the 20 metric ton of load. You can load it into your vehicle. I arranged for the vehicle. I loaded the entire 20 metric ton into that particular vehicle. Vehicle started moving, and before I enter my premises, I have a doubt whether this is 20 metric ton or not. By just seeing it, I can't know whether it is 20 metric ton. So what am I supposed to do? I will take it to a weigh bridge. Their weigh bridge basically works like this. I know what is the lorry weight, which is empty. I know what I'll try to take out what is the weight of the lorry with the goods in it. So whatever is the weight of the lorry with the goods minus the empty lorry weight will give you what is the value of what is the weight of those goods which are included in the lorry. But it is still an approximate figure because tank full, the weight might be different. Driver sitting in the lorry, weight might be different. So there are multiple factors that could change it. So weighment charges are always having an approximation of 5%. That's a general industrial norm of taking a weighment as an approximate of 5%. So that is how we normally do it. So whenever you look at this kind of cost of purchase, it includes purchase price reduced by the trade discount and added by non-refundable taxes, and also should be included by all costs incurred until the inventory reaches the enterprise premises. Now, that is your first one, cost of purchase. Let's look at the second one, cost of conversion. What do you mean by cost of conversion? Cost of conversion is nothing but the cost incurred to make sure that the raw material becomes a finished good. These are nothing but factory costs. In the factory, there's a machine run, there's an operator, multiple costs which are there. So all those costs which are incurred to make sure that the raw material turns into finished good is basically my cost of conversion. So let's try to understand this cost of conversion. Cost of conversion basically indicates factory overheads. Such factory overheads which I talk about or factory cost I can talk about can be identified in two ways. One is called as variable cost or variable overheads, and second one is fixed cost or fixed overheads. Now I'll have to use a little bit of costing knowledge into this because variable cost or variable overheads should be absorbed on the basis of actual production, absorbed on the basis of actual production. Fixed overheads or fixed cost, I will have to absorb it on the basis of absorbed on the basis of normal production. This is your costing techniques which I am talking about. There is no accounting which is involved in identifying the cost of inventory. When it is absorbed based on normal production, then I can have a situation where the actual production is less than normal production. Sometimes the actual production is also greater than normal production. So two scenarios normally arise. Let's look at these two scenarios. actual production is greater than normal production, or sometimes actual production cost, or sorry, actual production units is less than normal production unit. What happens in each of these scenarios? Let's look at it. I'll take an example to explain this, guys. I'm leaving a little bit of space so that I explain you with the help of an example. Example for absorption of fixed overheads. Let's take a numerical example and understand. First one, let's say the fixed overheads I'll write it as OH, okay? For overheads, it becomes easier for me. Is let's say rupee 1 lakh, or just to make sure that it's easier for us to calculate, I'll take it as 75,000. Okay. My normal production is generally 1500 units. Therefore, my absorption rate, how do you calculate absorption rate? Costing, all you have to do is 75,000, which is the actual cost. I'll reduce it by 1500 units and I will get a per unit rate. Per unit rate is 50. Correct? Now let's look at the scenario. The first scenario which I'm going to take is where actual production is greater than fixed overheads. Second one where I'll take actual production is less than fixed overheads. Actual production less than normal production, and actual production greater than normal production. Let's take both the examples. Let's say the actual production normally it is 1500. Since I'm taking less than that, I'm here considering it as only 1200. Okay. In this case, since it is greater, I'm taking the actual production units as 2000. Okay. Now let's look there. Now when I'm talking about this kind of problems, here look at the overhead absorbed. What is the overhead absorbed? 1200 units into what is the rate of absorption per unit? 50 rupees per unit. That means it results in an answer of 60,000. But what is your actual fixed overheads? The actual fixed overhead is 75,000. How much did you absorb? 60,000. So balance 15,000 which I have, I'll write it as balancing figure. This is basically called as under absorbed overheads. This is called as under absorbed overheads. While in the other scenario, look at the overheads absorbed. In this case, the overheads absorbed is equal to how many units? 2000. What is the overhead absorption rate per unit? 50. Then what happens? The total overheads absorbed is lakh. What was the actual fixed overheads? 75,000. How much is absorbed? 1 lakh. So that means in this case there is a over absorbed overheads. Over absorption which results in 25,000. There is nothing but 1 lakh actual overheads absorbed minus 75,000 actual overheads incurred gave me a resulting figure of 25. Now what is the treatment of this under absorption and over absorption? In the first case where I got under absorption, this under absorbed overheads should be straightforward charged to P&L. Therefore, it will not affect the cost of inventory. Will not affect cost of inventory. Look at the second logic. Where there was over absorption, in this case, I will revise the absorption rate. How will you revise the absorption rate? Look at this. Based on actual production. What should be the absorption rate based on actual production? That is, total overheads are 75,000. I'll have to divide it by how many units were actually produced? 2,000. So that means the actual absorption rate will turn out to be only 37.5 per unit, where instead it was earlier 50 rupees per unit, has now been revised to 37.5. Now let's go back and let's try to give the effect here where we have written where actual production is greater than normal production, there will be an over absorption, where in the case of over absorption I will have to revise the absorption rate. How will you revise the absorption rate? Based on actual production. Second one, where actual production is less than normal production, like we have already seen, this results in under absorption. In the case of under absorption, the under absorbed overhead should be charged to P&L. Under absorbed overheads should be charged to P&L. These are the two treatments that would arise in the case of fixed overheads where the actual production capacity is not equal to normal production. Sometimes it is greater than normal production, sometimes it is less than normal production. I helped you with an example in numericals on what could be the potential treatment whenever the actual production is less than or greater than the normal production. We are done almost with this concept of cost of conversion. But however, there's another small topic which will come up in between within the production cycle, which is also very, very important to understand. So let's get into that concept of byproducts and joint products. What are these byproducts and joint products? which arise in the production cycle. What is a differential treatment for byproducts and joint products when it comes to the measurement of cost? So now that we have understood overabsorption and underabsorption, let's get into the next concept of joint products and byproducts. The concept regarding this joint products and byproducts is very simple. Let's put up a heading, joint products and byproducts. And why are we dealing with that in combination? I'll tell you. The concept of joint products and byproducts is that there are certain raw materials, labor, and other overheads. All three combined are put into a production process. All three combined go into a production process. At the end of this production process, I don't get one item, but instead I got two products. I got a product X and a product Y. Now my question is very simple. What is the cost of product X? What is the cost of product Y? Will there be any difference had X and Y been joint products? Will there be any difference had X and Y been byproducts? That is the exact question which I am talking about. So this X and Y which I have written could either be joint products or could be byproducts as well. So the question asked here is very simple. What should be the cost of X and what should be the cost of Y? Let's look at it. Very simple logic that I'll apply here to define about it. If they were joint products, then in such situation, the production cost should be a portion on the basis of on a reasonable and consistent basis. What do you mean by this reasonable and consistent basis? According to our costing logics, this reasonable and consistent basically means in the proportion of their fair values at the point of split off. At the point when I got both the products of joint products and byproducts, that is called a split off point. At that point, what would be the fair value of each of this product should be the reasonable basis of allocating the cost or the production cost between these joint products. What if these were not joint products but they were byproducts? In such situation, I need the cost of byproduct. I also need the cost of the main product. Byproduct is nothing but the waste or something which comes incidental to the main product. Byproduct should always be measured at NRV, while the main product will be total production cost until split off point minus NRV of byproduct. Very good. Something I wrote, something which is making sense, but something which is not. Let's say, for example, you were into manufacturing unit and you got an order for a production of a 9 feet rod. You went into the market to find a 9 feet rod, nowhere it was available. Either you would get a 5 feet rod or a 10 feet rod. 5 feet rod cannot become 9 feet. Bought the 10 feet rod, cut 1 feet out of it, and made 9 feet rods. Now, in this production process of cutting a 10 feet rod, you got a 9 feet rod, which is the main product which your intention was to produce. But unintentionally, not just the 9 feet rod, I also produced a 1 feet rod. Never my intention, but I still got. Such kind of products are basically called as byproducts. Byproducts in the sense I had no intention of producing them. My intention was to produce the 9 feet rod. When I intended to produce the 9 feet rod and I applied a production process, incidentally I produced another particular material, which is the 1 feet rod. So this 9 feet rod and 1 feet rod are basically called as the main products and joint and byproducts. When do they become joint products? I have a production facility, okay, and I got an order to produce a 9 feet rod and a 6 feet rod. I went into the market where a 10 feet rod was also available, but I preferred to go with the 15 feet rod. In that 15 feet rod, what I've done is I have exactly cut as 9 feet. So I got a 9 feet rod as well as a 6 feet rod. Out of 15 feet, if I cut it to 9 feet, I'd get a 9 feet rod as well as a 6 feet rod. Now, if someone asked me, what was your intention to produce? My intention was to produce both that 9 feet rod as well as that 6 feet rod. So therefore, you cannot call that 6 feet rod as a byproduct, but it was your intention to produce that 6 feet rod. Therefore, it becomes a joint product. So very simple casual example I've taken for you to explain what is this joint products and byproducts. Now let's try to take up with an example and see how the joint cost gets split up. I had a joint cost of 75,000 rupees. At the split off point, I got two products. At split off point, I got two products. Product A, product B. While A, I got 100 units, each one having a market price per unit at that split off point was 50 rupees per unit. Okay. While product B, I got 50 units, 550, let's take 150 units. Each one had a cost of 20 per unit. Now, what if I consider them as joint product? What if I consider them as byproducts? If I consider them as joint products, then what is the cost of A and B? If I consider them as byproducts, that means B considered as a byproduct, and what would be the cost? A and B. Now let's see. If I would have considered it as a joint product, then I would have taken it in the proportion of their fair value at split off point. What is the fair value at split off point? Calculate. Oh, one second. I'll just make a small change. Take this as 500 and this is 200, okay? Wouldn't make sense if I'm taking it so low. So this became 50,000 rupees, and at the same time this became, how much is this? 30,000. If I would have considered it as a joint product, then A would have been measured as, what is the total joint cost? 75,000. What is the proportion? Into 5 by 8. 75,000 into 3 by 8. Had I considered them as byproducts and B being a byproduct, I would have measured this as 30,000, while byproduct A, while the main product A would have been measured at 75,000 as the total cost minus 30,000 value of byproduct. So I would have got the value of 45,000. Want to calculate? I'll just calculate and show you the numbers. 75,000 into 5 by 8. This would have been arriving at an answer of 46,875. Then this would have been 28,125. So there is a change in valuation if it was A and B having the same number of units and the same market price, but both being considered as joint products and byproducts, would have given you a complete different logic of valuation altogether. This is the reason why joint products and byproducts become really important for you to understand. Yeah. Yes, guys, so like we have seen in the previous section about joint products and byproducts, that will bring us to the end of the concept where we discuss about cost of conversion. If you remember, we were talking about three components of cost to be included in the cost of inventory, and those three costs were basically cost of purchase, cost of conversion, cost necessary to bring the asset to its current location and condition. Now, what is such other cost to bring the asset to its current location and condition should be the last discussion about the inclusions in cost. Cost incurred to bring the inventory to its current location and condition. I'll talk about condition first and then I'll get back into location. Ultimately, our aim is to complete both the concepts. So let's understand in basic simple sense what are these two costs. Let's say, for example, we have gone to a particular, let's say, very very simple, industry that I can talk about is packaged mineral water, right? So packaged drinking water is a very commonly supplied 20-liter cans or a 1-liter can with 1-liter bottles which are normally available. Now, if I talk about, we go into a valuation of this kind of industry and I go into the manufacturing unit and I observe that in total there was about 6,000 liters of packaged drinking water available. Now, when I asked the store owner or the manufacturer on where is that 6,000 liters, he showed me a big, container, and he said this container has 5,000 liters. I asked him where are the remaining 1,000. Then he said the remaining 1,000 are packed into 200-liter bottles, a few into 1-liter bottles, a few into 2-liter bottles, few in 500 ml bottles. Now, if I'm going for an inventory valuation and looking at the cost sheet, I arrived at that the cost of manufacturing each liter of mineral water was only 5 rupee 50 paise, then that means the cost of inventory should be 6,000 liters into 5.5. The answer is absolutely wrong. Why is the answer wrong out there? Very simple logical reason that I can come out with is the inventory is not completely in the same manner. A few inventory is in the container, a few inventory is in 20-liter bottle can or 20-liter cans, 1-liter bottles, a few in 500 ml water bottle. So the condition in which the inventory is situated is also necessary for me to include it. So somewhere someone might have already generalized saying that the packing cost should be included in the cost of inventory. My answer is absolutely yes. So I'm putting up with an example. I'm just not going away from this logic where I was discussing about it. But I'm saying, if for example, I have an inventory is equal to 6,000 liters of packaged drinking water, and the cost per liter was about 5.5, then in such situation, I cannot come up with the total logic saying that this total value is 53,000. Then this answer would be absolutely wrong. Because I'll have to assess how the 6,000 liters is basically contained in. So my 6,000 liters is in three forms, let's say. Just to keep it simple, I'm just putting it up in three forms. One form is 5,000 liters in a container. Same time, about 600 liters in 20-liter cans, and then final 400 liters I had in 1-liter bottles. If I have it in these three forms, probably this one is absolutely right, where I can take 5,000 liters into liters. Is this 5,000 liters into rupee 5.5 per liter? This is fine. But when I talk about this 600 liters, this 600 liters should be 600 into 5.5 per liter plus amortized cost of each 20-liter can. Why did I use amortized cost of each 20-liter can? Because the 20-liter can is reused again and again. Since it is reused, the entire cost of 20-liter can cannot be allocated to that particular inventory. So let's say, for example, the 20-liter can is 100 rupees worth and I can use it like 50 times, then I can basically allocate it as 2 rupees per every can per one filling. So 2 rupees per liter per filling. So that means for every 20 liters, it should be 2 rupees per liter. Sorry, 2 rupees. So that way, I have to add the amortized cost of 20-liter can. But when I'm talking about this 400, then I'll get a complete different logic, because I'll apply 400 liters into 5.5 rupees per liter. But since I'm not going to use the bottle again, or the bottle is not held for reuse or refilling, plus the cost of 1-liter bottle, this should be the total inventory value. All this put together should give my total cost of inventory. So that means I'm adding certain things based on the condition in which I find the inventory. I find the inventory in the packed condition, then the packing cost also has to be included. Now there I can, maybe people might have come up with a conclusion that I would be pulling in an arrow mark from here and I will include all packing cost. immediately I'll come with a logic saying that all packing costs should not be included in the cost of inventory. Then question comes up, then what is the packing cost which should be included? Here you anyways included the cost of the can, the cost of the bottle you did. Then my logic is what is that which is not included? My packing cost is divided into two types. One is called as a primary packing. One is called as the secondary packing. Then question comes up, what is primary, what is second? Primary packing is the packing necessary to make the good marketable. What does it mean? Without that packing, I cannot sell. You are there to sell milk, man. Sell milk without packing it. It is compulsory. Without the packing of the milk, either in the plastic cover or in the tins, it is not packed. The Tetra Pak normally holds it for 3 or 4 days. A normal packet, a plastic packet, might not hold it for so long, maybe for a couple of hours. That's it. So that means the packing is making the good marketable. Without such kind of packing, it may not be possible for the good to be marketed. A Tetra Pak, each liter costs approximately 50 to 60 rupees. But a normal packet or liter of milk might be costing much lesser. Now, you cannot say that the Tetra Pak was unnecessary. The Tetra Pak was necessary to make sure that the good is held for a longer period. Got it? So that will still be called as a primary packing material. Primary packing should be included in the cost of inventory, while secondary packing should not be included in the cost of inventory. What is secondary packing? There's no particular definition for this. Anything other than primary packing. You want some examples for this? I'll give you. Very engaging advertisement that we get is basically the advertisement of Kinder Joy. I don't know how many of you have seen this advertisement, how many of you have tasted it. Kinder Joy is a small chocolate, okay? And he says you will find a toy inside that. So I find it very, very attractive egg-shaped packing for it, and I open it. I have all the filling which is there inside, and inside I'll find a small toy. My question is, the toy which is kept inside, is it necessary to make the good marketable? Not necessary. Absolutely not necessary. Even without the toy, the person who is consuming it would get the same benefit as much he would get even if the toy is there. The toy is not enhancing the flavor. The toy is not making the good for a sustainable for a much more longer period of time. These big bubbles or boomers or whatever you used to get, and there were some tattoos which were attached along with it. So without the tattoo, the boomer does not give you a bubble or what. There's nothing like that. So such kind of packing is only a packing which is making the product more attractive. That is not making the good marketable. Those packings are called as selling and distribution. Secondary packing should not be included because it contributes to selling and distribution expenses. It can be considered as selling and distribution expenses, which is specifically excluded from the cost of inventory. Remember the cost of inventory exclusions, the 5 exclusions that I have given you, very clearly I have excluded selling and distribution costs. So that means, what is that secondary packing meant for? Secondary packing basically is meant for marketing the product. The secondary packing is basically making the buyer choose for this product over any other substitute available because it has something extra, not just that particular material with it. That is secondary packing, which should not be included. Primary packing is the packing which makes the good marketable, just like packaged drinking water. The water bottles are 20-liter cans. Without this, how would you give water? It is not possible for me to supply water without a container along with it. So that is the reason why this has to be considered as primary or secondary packaging. Bottle is fine. Labeling around it, is it necessary? Labels which are put around in the same example, I'm not deviating from the example which I've given. My question is, labels around the bottle, absolutely right. You find Kinley, Bibo, all this. My question is, should I consider this as primary or secondary packaging? Bottle is fine. Bottle, you already came out with the logic saying that a good is not marketable without the bottle. Therefore, it is primary, fine. But the label around the bottle, is it primary packing or secondary packing? Primary packing or secondary packing? The label around the bottle. And the answer is, it is secondary packing. Because without the label also the good can be marketable. Therefore, the label cost should not be included in the cost of inventory. Not included in cost of inventory. Now I hope you people will agree that discussing Ind AS 2 in CA final level is important, because all these tiny points you never thought about before. So my interest in discussing Ind AS 2, I could have very well said that anyways Ind AS 2 you have already read multiple times as inventory, why should I discuss it all over again? Because I know I can make certain points which are quite new or which you will be completely unaware of when I'm talking about it. So that is the reason why Ind AS 2 is also inventory for CA final level, because what you have learned till now and what you will be learning now, I think you will have to look at a different dimension to it. Very important to look at a different dimension to it. So until now, what I have been discussing about is only about the current condition. Correct? It is a condition where packing cost should be included, out of which all packing cost is not included. Only the primary packing which is necessary to make the good marketable is included. Any other packing which is attached is not supposed to be included, and it is considered to be selling and distribution cost. This is what we have understood with the help of some example where we took the packaged drinking water. I'll continue with the same example, okay? I'll continue with the same example to explain what is a current location. When I talk about current location, my concept is very clear. Put your head into this logic now. When I talk about current location, let's say my manufacturing plant is located 50 kilometers away from the city. Okay? I'll give you an example. This is my factory or my manufacturing unit. This is the city which I provide the material. The distance between these two is approximately 50 kilometers. Quite far off. Because obviously, packaged drinking water is not available in city limits. In city limits, already the groundwater level is gone. So away from the city, I dig 1,000-meter bore, so that the 1,000-meter bore has a lot of water in it. I put it through a process called as reverse osmosis. That is what your Kent RO and all that do. So instead, I'll put it in a bigger plant, and that water I will fill it into small bottles, and that became drinking water. So if I look at such kind of factory was set up about 50 kilometers away from the city. It is not possible for me to transfer each unit to the city. 50 kilometers of travel I have to do. If I get a call from somewhere in the city saying that 20-liter can is necessary, I can't send it from the factory to the city because it is quite far off. The transportation cost is quite expensive. So what I do? Within the city limits, I will create a go down. So instead what I'll do? I'll supply from factory to the godown. Instead of directly supplying from factory to the city, I'll supply it to the godown. The godown, I'll supply it to the city. So bulk quantity at some point of time, I'll keep on dumping into the godown, and the godown will actually transfer it to the city so that the transportation cost is reduced to a major extent. Right opposite my office, I have a huge godown where you find that this packaged drinking water gets supplied. I take examples from the things which I see right in front of me. So this is one example which I observe. Now, if you ask him, why did you do that? Why did you transfer it to godown? My intention is basically to reduce my transportation cost. Reduce the transport cost. That is my only interest in setting up a godown. Extra rent I have to bear. Now my question is, the inventory in the factory and the inventory in the godown cannot be measured at the same level, cannot be measured at the same price. 100 liters in the factory is not equal to 100 liters in the godown. I'll tell you why. Inventory in godown should be valued at factory price plus transport cost. While the inventory in the factory is valued at factory price. That means it is the same inventory. There's no change. If I would have consumed that 1 liter of water bottle in the factory, or I would have consumed that 1 liter of water in my godown, would have given me the same utility. But the value of the inventory is not the same because the transportation cost incurred is enhancing the value of the inventory. How did it enhance? Dude, instead of actually transporting it from the factory to the city, I'm transporting it directly from the godown to the city, reducing the transportation cost. So transport is a necessary element of that particular inventory. Had that transport cost not been incurred, then the factory becomes unviable to run. It improves the value of the product. Got it? I'll put it like this. There are 3 transportation costs which I generally incur. What are the 3 transportation costs? Transport cost is split into 3 parts. First one moves from supplier to factory. Second one moves from factory to warehouse or godown. Third one moves from godown to customer. Which transport cost should be included in the inventory? Which transport cost should be excluded from the cost of inventory is the discussion. Supplier to factory premises. I'll go back above to your purchase price. I'll go back above to the purchase price and I'll tell you here. Look at here. All costs incurred until the inventory reaches the enterprise premises includes the transportation charges. Therefore, come down and I'll say the supplier to factory, cost should be included in cost of purchase. We just discussed this part, factory to go down or warehouse should also be included in cost necessary to bring the inventory to its current location and condition. Then what about this cost or the transportation cost incurred to send the inventory from the go down to the customer premises? From go down to customer premises, I'll exclude it. Excluded in cost of inventory. Reason is it will be a distribution expense. It is a plain distribution expense which should be straightforward charged to P&L. Therefore, since it is a distribution expense, I should not be including it in the cost of inventory. Exclusions from cost of inventory, we have already discussed the distribution cost there. So there's a distribution expense, I will directly charge it to P&L. No including it to the cost of inventory here. So 3 transportation costs, 3 different treatments which is coming up. 2 places it is added to the cost of inventory, 1 place it is excluded. So that is the cost which is necessary to bring the inventory to its current location and condition. So under current location, just to give you an information out here, I will include transportation cost. Just for further information, I'll put an asterisk and I'll say see below for more discussion on this. We have already done. Second one, unloading cost. If you remember, I'll tell you why this concept comes in. If you remember cost of purchase, I'll go back above and I'll talk about this. Here I've included loading cost, right? But where is the unloading cost? I took the material from the supplier and I put it into the lorry. But that itself is not the sufficient thing, because after the lorry reaches my factory premises, I'll also have to unload the material. So that unloading cost is not included here. Therefore, I'll include that unloading cost as a part of my cost incurred to bring the inventory to its current location and condition. That is the last part of inclusions from cost. From here on, we'll further talk about exclusions from cost.